Hello students, welcome to day 9 of Mathematical Theory of Interest course. In today's discussion we will continue our previous day's topic about annuities, and we will try to understand this concept or this topic from practical aspects. We will use different kinds of practical examples to elaborate these concepts more clearly. So quickly moving to our topic. In this topic we will try to understand the annuity due. We will try to understand the working of uneven cash flows. So here is a difference. Here is a very quick definition of the annuity due we discussed previously. So I will quickly move on this slide. We already know that when the payments are made, when equal payments are made at the start of every accounting period for a limited time period, this is called annuity due. And here are some practical examples of annuity due. Normally in case of lease payments, payment of vehicle loan, automobile loans, rent property, and typical lease contract requires payment at the beginning of each accounting period. So in case of making payment of these kinds of transactions, we normally use the annuity due concept. Remember, these are the some clues to identify annuity due. These are the important tips. How you can identify whether it's an ordinary annuity question or it's an annuity due question. So if in the question, if it is mentioned that the payments are made at the beginning of each period, the payments are made in advance, the first payment made today, or the payments are starting now. If any of this sentence is given in your question, it means this is a question of annuity due, not ordinary annuity. This is a question of annuity due. Remember, if the question is silent, then you will assume that this is an ordinary annuity question. There is a little difference between ordinary annuity and annuity due. In ordinary annuity, we make payments at the end of every year, every accounting period, while in annuity due, the payments are made at the start of every accounting period. These are the formulas to calculate the future value of annuity due and the present value of annuity due. Future value of annuity due and the present value of annuity due. So remember, while calculating the future value of annuity due, we are required that the compounding of cash flows for one additional period beyond an ordinary annuity. We will just add up. This is very simple formula, very similar to the present value formula, but only addition is 1 plus I. This is the 1 year interest rate factor for additional calculations, because every payment requires 1 year's additional interest calculations. Here is a very simple question as we discussed previously, and we will discuss from the annuity due perspective. We will use 3,000 annuity payments at the rate of 5% for the next 10 years to calculate the future value of this annuity due. So after inserting all these values in the question, in the formula, our answer is 39,620. This is the question. This is the formula to calculate the present value of annuity due. We will use our previous example to elaborate this formula, and after making all calculations using annuity due formula, finally we have 67,590. Remember, these examples illustrate that both the future values and the present value of annuity due are larger as compared to annuity due, as compared to the ordinary annuity. What is the reason behind that? Because every payment requires one additional interest payment, one additional year interest payment, because every payment is made at the start of every accounting period. Now this is a question for your practice you are required to calculate the present value of a 3-year annuity due of $100 at the rate of 10%. Here N is 3, I is 10%, and payment every year payment is $100. You will just use the future present value of annuity formula to calculate the present value of annuity of this question. Remember, I have mentioned the answer, which is 364.10. If your answer is the same, it means you have understand the whole calculation very correctly. If your answer is different, then you need to recheck your calculation and find out where is actually the incorrect portion in your question. Now next one is understanding the perpetuity. The perpetuity is basically, in previous classes we have discussed the perpetuities in detail. Now we will just look at from practical aspects of this perpetuity concept. A perpetuity is an annuity that continues forever or has no maturity value. For example, a dividend stream on a share of preferred stock, or a share of common stock. If you make investment in equity stocks, normally in case of stock payments or stock investment, we assume that the life of the company is unlimited. So in calculating the value of a preferred stock or value of a common stock, we use this concept, perpetuity concept. There are two types of perpetuities: growing perpetuity and level perpetuity. In growing perpetuity, we assume that the cash flows grow at a constant rate of interest every year, while in level perpetuity we assume that the payments are made at a constant rate, not at a growing rate, at a constant rate. These are some examples of perpetuity. This is the formula to calculate the present value of a perpetuity. Remember, in case of a perpetuity, we don't calculate we don't calculate the future value of perpetuity. Why we can't calculate the future value of a perpetuity? It has very simple answer. Because in perpetuity the future time period is not mentioned. They will continue for infinity time period or unlimited time period. So we are not aware about the future or the maturity time period of that perpetuity. That is why in perpetuity we can only calculate the present value of that perpetuity. We can't calculate the future value of that perpetuity. This is the very simple formula to calculate the present value of a perpetuity, which is payment divided by I. Payment divided by I. Now, perpetuity of a present value of a growing perpetuity. In present value of growing perpetuity, the rate of interest grows at a constant rate every year. So we will just add up the denominator and deduct G from interest rate to calculate the present value of a perpetuity. This is how you can calculate the present value of a perpetuity, growing perpetuity. From this, in this example, payment is $100, interest rate is 5%, and growth rate is 3%. After inserting all these values in the formula, we can calculate the present value of this growing perpetuity is $5,000. These are mostly used in case of making the calculation of stock prices, because the dividend are supposed to increase every year. Now let's review the whole concept of these perpetuities and these annuities. These are the formulas of the present value and the future value of lump sum payment. These are the formulas to calculate the annuities. This is very important. Remember these formulas. I will again suggest remember these formulas. Memorize these formulas. If you want to save your time during the exam, just remember these formulas. These are the calculation of the level perpetuity and the growing perpetuity, how we can calculate the present value of these perpetuities. Now, next one is the uneven cash flows or complex cash flow streams. Cash flow streams in the business world may not always involve one type of cash flows. Cash flows may have a mixed pattern. For example, different cash flows amount mixed in with annuities. For some time period we have annuity payments. After we have uneven cash flows, then again annuity payments, then again uneven cash flows. It will be like that. For example, this is an example given to us for the 10 years cash payments. In the first year cash flow is 500, second year 200, third year we have cash outflow which is 400, and after that from year 4 to year 10 we have equal payments of 500, and the interest rate is 6%. We are supposed to calculate the present value of this project. Now we will assume from year 4 to year 10 as an annuity, and we will treat first 3 years payments as lump sum values. And here basically we will require to calculate 4 different calculations if we want to calculate the present value. First calculation is $500. We have to discount it for 1 year. For $200 we have to discount it separately for 2 years. For 400 we have to discount it for 3 years, and rest we will treat it as an annuity, and we have to first discount it for 6 years, and then further discounts compound discount it for 3 further years, and then finally we will add up all these calculated values, and that will give us the total present value of that project. So first of all we need to draw a timeline. We draw a timeline. Remember, the negative cash flow we will just need to deduct this cash flows value. The first 2 cash payments are uneven cash flows. Third one is the cash outflows, and after that we will need to calculate their present values using the lump sum present value formula separately. Then we will make calculations. Then third year negative cash flows, we will calculate the negative cash flow payment and then minus it. This is the calculation of the third. This is the third calculation. Now final fourth calculation of these annuity payments starting from 4th year till 10th year. Starting from 4 year till 10 years, we will treat it as an annuity. For that we need to make 2 calculations. First of all, we need to calculate the present value of this annuity, then we will further discount it for 3 years. The first calculation we will treat it as an ordinary annuity to calculate its value. And there are total 7 payments, so we will discount it. We will calculate the present value of this annuity for 7 years, and then we will further discount it for next 3 years. And finally we have 3 values. For 500 we have its discounted value is 471.70. For $200 its discounted value is $178. For negative cash flow, which is 400, its discounted value is minus 335.85. And the last one is the annuity calculations. We have calculated its value, and final value at 0 time period is 2343.54. And we have then finally we will add up, subtract all these values together, and our final total present value is 2657.39. That will this is how we can calculate the present values of mixed cash flow stream. This is how we can calculate the present value of mixed cash flow stream. Present value of mixed cash flow stream, or we can say that the complex cash flow stream. This is how we can further. This is some more explanation of this concept. So remember, this is the total procedure that I have explained to you. You just go through this by yourself. This is another example. We have a mixed cash flow stream, and we are required to calculate the present value at the rate of 10% of this mixed cash flow stream. So again, you can make your calculations by using the previous method, to calculate the total present value. This is another example just for yourself. I will leave this example to you to practice this question, to to differentiate between cash flow A and cash flow B and find out which cash flow is better. The cash flow which is given to you, which is giving you the highest present value is preferable for you from investment point of view. You have two investment options. First option is option A and option B. Interest rate is 8% compounded annually at the find the present value of these cash flows. Which one would you prefer and why? Which one would you prefer and why? So in future, both cash flows are giving you equal results, but you need to evaluate this by using the present value. The cash project, the project which has the minimum present value will be acceptable. Minimum present value mean minimum investment value, because you need to invest today. So you just need to calculate this you just need to calculate these values by yourself, and if you have any question you can ask me anytime. Thank you so much. Bye bye. See you in the next class.